More and more Europeans are investing in ETFs, but 9 times out of 10, they pick the wrong ones. These are ETFs that are risky or expensive or bad for taxes. In fact, out of the thousands available, there might only be 5 or 10 ETFs which are right in your individual case. So let me use my 18 years of professional experience, both on Wall Street and as CEO of a European investment company, to walk you through 12 things to check before buying an ETF. I will also reveal 3 things you should ignore unless you want to make an expensive mistake. To start with, let's say you're on justetf.com and you want to choose some ETFs. The first thing you need to check is the ETF type. Now, what do I mean by that? Well, when experts like Warren Buffett and Nobel Prize winners in economics recommend ETFs, they are usually talking about a type of ETF called an index fund. So for example, if we look at an ETF like the iShares Core MSCI World UCITS ETF, okay? When we look at the description, we see that this ETF tracks the MSCI World Index. Basically, it buys all the stocks included in the stock index and it gets you the average result of this index with low costs. But not all ETFs work like this. For example, you have the Fidelity Pacific ex-Japan Equity Research Enhanced ETF. And this ETF is what is called an actively managed ETF. Instead of tracking an index, this ETF is run by a team of experts which try to pick the best possible stocks and get a better result than the index. Now, actively managed ETFs are not necessarily bad. They have a chance of outperforming the market average. But the reason everybody recommends ETFs is really because there is so much data showing that index funds get good results. So if that is what you're looking for, you want to avoid these actively managed funds. Then next up, we have a type of ETF that can be much more dangerous. It is called a leveraged ETF. For example, the Amundi MSCI USA Daily 2X Leveraged UCITS ETF. What does this ETF do? Well, it tracks the 2 times leveraged performance of MSCI USA on a daily basis. So basically, if the MSCI USA index goes up by 1%, this ETF should go up 2%, and if it goes down 1%, this should go down 2%. These kinds of leveraged ETFs are quite complex and risky. They are not suitable for long-term investing. If you hold such an ETF for 5 or 10 years, you are not going to get double the index result. Your result will be much worse for various technical reasons. So for most amateur investors, this is probably something you will want to avoid. And this goes double for the next category, which are inverse ETFs, like the Xtracker's S&P 500 Inverse Daily Swap ETF. So this kind of ETF goes up when the market goes down, and it goes down when the market goes up. But as you probably know, over the long term, the stock market tends to go up. So these kinds of ETFs tend to go down. They are only really appropriate for making short-term speculative bets. And this is something you should stay away from unless you are an experienced trader and this is what you do for a living. And then you will also run into some exchange-traded products which are not ETFs at all. Like, for example, this CoinShares physical Bitcoin exchange-traded commodity. It trades on a stock exchange the same like an ETF. It kind of looks like an ETF, but it's not. This is a financial product which gives you exposure to the price of Bitcoin. Or you have this iShares physical gold ETC, which does the same for the price of gold. With these kinds of products, you don't get one of the biggest benefits of ETF investing, which is diversification in hundreds of different stocks or bonds. So if you want to use them, be careful, make sure that you know what you're doing. Going forward, I'm going to assume that you want to use ETFs to invest in stocks or bonds. And the next thing to check is the sector and theme of the ETF that you have selected. So most of the most popular ETFs out there, like iShares Core MSCI World or the iShares Core S&P 500 ETF, they are what are called broad market ETFs. They invest in many different companies across many different sectors. But there are many ETFs out there these days which get marketed quite heavily, which focus on specific industry sectors or themes. How do you check which sectors your ETF covers? Well, on justetf.com, when you open up an ETF, there's this useful section called Holdings. Go down there and you will see sector weights. So for example, here we see that technology makes around 28% of the ETF, financials make up 15%, industrials make up 10%, and so forth. Whereas if we look at this information technology ETF, if you look at the holdings, you will see that it's all in the technology sector. For thematic ETFs like this VanEck Defense UCITS ETF, it's a little less clear because when you have a theme like biotechnology stocks or defense stocks, these stocks can actually fall into different market sectors. So basically, you have to look at the description and figure out if this is kind of a narrow ETF that focuses on one type of stock, or is it a diversified ETF that covers many industries and many types of stocks. Which is better? Well, if you have a very strong view that, for example, defense stocks or semiconductor stocks are going to outperform, you can use sector and theme ETFs and hopefully get good results. But I do have to warn you, there's a tremendous amount of evidence out there that most sector and theme investors get quite poor results. Typically what happens is that a sector like defense stocks gets really hot, stock prices shoot up, investors are excited, so then ETF providers launch a new fund to capitalize on all this interest. Investors jump into the ETF, and by that time the hype has reached the peak and it starts going down, and the ETF underperforms. If you want to invest in sector and theme ETFs, you have to be really sure that you're jumping in at the right time and you know what you're doing. So going forward, I'm going to assume that you want to invest in broad market ETFs without focusing on a specific sector. Then the next thing that we want to check is the geography of the ETF that you have chosen. Well, on justetf.com, you can again go to the section holdings. So for example, for this developed world fund, we see that around 68% of your money would be invested in American stocks because the American market is the biggest by size. Then you've got Japan and the UK and Canada and Switzerland and other markets as well. Now, of course, if you look at something like the iShares Core S&P 500 ETF, I mean, this tracks the S&P 500 index, which is the 500 largest American stocks. So this is going to be 100% America. And similarly, you can find different ETFs that target different global regions if you like. Now, which is better? This is actually quite a complex question, and there is no single right answer. A lot of smart investors simply use a global ETF, an ETF that tracks maybe the MSCI World, or if we scroll down here, we will also see like this Vanguard FTSE All World ETF. It's quite popular. It invests in both developed and emerging markets. But there is a problem with this kind of global ETF, which is that most of your money still gets invested in America. And today, with Donald Trump's politics and all this antagonism between America and Europe and the weakening dollar, there are a lot of investors who are not fully comfortable with that. Other investors prefer strategies like putting more of a home bias and including more European ETFs in their portfolio, or even excluding the US from their portfolio completely. This is the decision that you have to make based on your personal preferences. The reality is that nobody can predict for sure which global region will do the best long term. What I would say is that you want to make sure and stay diversified. The next thing I would check is sustainability. A lot of European investors that I talk to really don't want to invest in companies that don't align with their moral views. Perhaps you don't want to invest in tobacco companies or oil and gas companies or weapons manufacturers. This really depends on your personal moral stance. Now, fortunately, these days, there are quite a few ETFs out there which are built for this purpose. If you go on justetf.com to this section sustainability and select only sustainable ETFs, you've got around 1,500 different ETFs to look at. But the challenge is that everybody's moral views are a bit different, so the definition of a sustainable ETF can be wildly different from fund to fund. So for example, if I wanted to invest in the S&P 500, I would put that here in the search bar, and now I've got 36 different sustainable ETFs which have S&P 500 in the name, and I can start going through them and read the description and figure out how they define sustainability. One note that I would make about this is that, unfortunately, market research suggests that choosing sustainable ETFs or investing in sustainable stocks doesn't necessarily do much to improve the behavior of the corporations involved. You can probably have a bigger impact by living in a sustainable way as opposed to selecting only sustainable stocks for your ETF. Next up, we've got currency hedging. So if you buy an ETF like the iShares Core MSCI World ETF, for example, that means you're investing in developed world stocks all over the world in many different currencies. If you are based in the Eurozone, that means you are going to have currency risk between the dollar and the euro, the Japanese yen and the euro, the British pound and the euro, and so forth. If you want to avoid this, if you want to neutralize this currency risk, that is possible by buying so-called currency hedged ETFs. On justetf.com, you have this section currency hedge, and you can choose ETFs that are hedged to Swiss francs, or euros, or British pounds, or the dollar, or even the Japanese yen. So for example, as a Eurozone-based investor, I might be interested in these euro-hedged ETFs. So that gives me 400 different funds to look at. But is currency hedging necessary? Well, it's kind of a nuanced question. In some scenarios, you are better off hedging your currency. In other scenarios, it kind of gets you worse results. So for most stock investors, I would say don't bother with currency hedging. But if you want to buy bond ETFs, then usually currency hedged ETFs would be recommended, or alternatively, you would just stick to bonds denominated in your local currency. Okay, the next thing to check is really important for your taxes. It can make a big difference. But before I address it, here's this. If you would like a faster, simpler way to learn ETF investing, which includes step-by-step training as well as individual answers to all your questions from me personally, you might be interested in my training program for European investors, the Index Masterclass. To find out more, just follow the first link in the description. Okay, so the next thing to check, which is really important for your taxes, is the ETF's use of profit. What does that mean? Well, if you go to use of profit here on Just ETF, you'll see accumulating and distributing. So accumulating ETFs are ETFs which get dividends from stocks and keep those dividends inside the fund. They use dividends to buy more stocks. Distributing ETFs are ETFs which receive dividends and pay them out to you as an investor. Now, from a financial perspective, in both cases, you are equally well off. The dividend is either inside a fund that you own, so the money is there, it's just inside the box, or it comes out into your brokerage account and you have direct access to it. So financially, both are the same. The main difference is actually the tax impact. In most European countries, accumulating ETFs are better for taxes because whenever you receive dividends, you have to pay tax immediately. But if the dividends stay inside the fund, the money can keep growing and growing and growing, and you only pay tax in the future when you sell. Unfortunately, in some European countries, including the UK and Austria and Switzerland, this doesn't quite work because you get taxed every year, even on accumulating ETFs. So this is kind of a country-by-country case. You have to check which is better in your country. The next thing to check can also impact ETF taxes. This is domicile. In simple language, domicile is where the ETF is legally established. So for example, you can have an S&P 500 ETF, which invests in American stocks, but which is legally established in Ireland or Luxembourg or somewhere else in the world. For example, if you're investing in the US market and you go here to fund domicile and you choose Luxembourg, which is a very popular domicile for European ETFs, then every time that a US company pays a dividend to this ETF, there's going to be a 30% tax that gets taken away. But if, by contrast, you have chosen Ireland, which is also a very popular domicile, then only 15% of the dividend will get lost in taxes. So for ETFs that include American stocks, usually Irish domiciled ETFs are better, but for other ETFs which don't include American stocks, both Irish and Luxembourg domiciles are quite common. And then if you look here, you will see that there's also a bunch of ETFs based in other countries, whether it's the Netherlands or Germany or Bulgaria or Switzerland. In most cases, these ETFs either cover the local stock market in those countries, and it gets them some tax benefits to be based locally, or they are meant for local investors that live in their country. The next thing to check is replication method. Now, what does this mean? Well, most ETFs that we look at are index funds, right? They track a market index. So inside the fund, you have kind of a miniature version of the index. For example, an S&P 500 ETF might invest in 500 of the biggest American stocks to get you the results of the S&P 500 index. So in a sense, the ETF replicates the index in miniature. But there's different ways this can happen. So if I scroll down to replication method here, I'm going to see full replication, hybrid, sampling, and swap-based. So full replication means that the ETF buys every single stock that's included in the index. Hybrid, I will address at the end. Sampling means that instead of buying every single stock, the ETF only buys enough stocks to replicate the average result of the index, but maybe some of the smaller, less important stocks that skips. And then swap-based means that instead of actually buying the stocks in the index, the ETF engages in a bunch of financial wizardry to get you the same result as the index. So swap-based ETFs are also called synthetically replicated ETFs. They add a little bit more complexity. They add a tiny little bit of extra risk. But on the flip side, they can often track the index better, and they can also have some minor tax benefits in some cases. All else being equal, most of the time, I prefer fully replicated or sampling ETFs as opposed to these swap-based ETFs. And then these hybrid ETFs, well, it's a new innovation. For various tax optimization reasons, sometimes an ETF will buy part of its holdings physically and then use synthetic replication for the rest of the portfolio. Next up, we've got costs and expenses. This is one of the final things that I usually check when I want to finalize my choice between a few different top ETFs that I'm looking at. So for example, let's say I've already chosen my ETF strategy. I want a global ETF that has no specific theme or sector, no specific strange strategy. It's an accumulating ETF with full replication or sampling based in Ireland. Okay, so that gives me 75 choices to look at. There's a whole bunch of different global stock ETFs to choose from, and I don't need that many. So to narrow down the choice, I might look at the TER, the total expense ratio, which indicates how much money this ETF will be taking from me in fees on average every year. If I click on TER, I can see the cheapest funds. For example, the Amundi Prime Global UCITS ETF right now charges only 0.05% per year. This is not the only criterion I would use. One more thing that I would check in terms of expenses is I would open up the fund and I would click on the Key Information Document, the KID. This is a standardized European Union document which has cost information in a consistent format. And on the third page, you can usually find this line, which is called the annual cost impact, which combines all possible costs. And this says 0.1% per year. Now, this can be confusing. Why did we have 0.05% here on Just ETF? And then this says 0.1%. Well, that's because in the key information document, they round things up. There's no 0.0 anything. It's just 0.1% or 0.2% and so forth. So usually my strategy would be to sort this list by costs and pick a few of the lower cost ETFs that look attractive and make my final decision between them. And when making that final decision, the next thing that I would look at is actually the size. Okay, it's here in the fund size column. When I buy an ETF, I do have a preference for slightly larger ETFs. So for example, even though it might be a perfectly good fund, I would be careful with something like the Franklin FTSE Developed World UCITS ETF in my personal case, not an investment recommendation, but just my opinion, because it only has 17 million euros invested. So that means that the fund provider right now is not making a lot of money from this fund, and this increases the risk that they might decide to shut the fund down. And this is not the end of the world, but it can mean that you have to reinvest the money. It's a hassle. It can create tax consequences. So usually I prefer funds which have maybe 100 million plus invested, or even more if we're talking about big global funds like this. Okay, now for the next thing that I would check. Let's say I've chosen an ETF like the iShares Core MSCI World UCITS ETF. Before I go ahead and buy it, I would like to check something called the tracking error. How well this ETF has actually tracked the underlying index historically. Usually this is not available on Just ETF. Instead, I will copy this ISIN, the International Securities Identification Number. I will go to Google and I will search for the homepage of the fund. So here it is on the iShares website. And on this website, I will go to the performance section. And usually you can get this kind of annualized table which compares the result of the ETF, the total return, with the index, also called the benchmark. And so I can see that since inception, the total return of this fund has been 10.9% per year on average, and the index has returned 10.95% per year on average. So that has tracked very, very well. And that is reassuring that the ETF is working as supposed. I can also look at a chart and I can see that basically the green line for the fund and the blue line for the index, it basically overlaps. In most cases, there is no issue with tracking error, but I have seen a few surprising occasions where the ETF has not performed nearly as well as the index. So if that happens, it's kind of a red flag and you want to figure out what is going on. And then before I address a few important things that you should not look at when choosing ETFs, there's one final thing to check, which is the tax registration of the ETF. Now, for most of you, in most European countries, this is not important. But if you live in a country which treats ETFs differently for taxes depending on their registration status, it does matter. For example, in the UK, you want ETFs which are considered UK reporting. Similarly, in Austria, you want ETFs which are called Meldefonds, which are reporting to Austria, and so forth. Where can you find this information? Well, this varies on the country, but Just ETF does have a bunch of useful information. So for example, for this iShares Core MSCI World Fund, if I scroll down, here I can see this section tax status, and it tells me that this is ESTB reporting for Switzerland, it's a tax reporting fund for Austria, and it's also UK reporting. So if I live in the UK or Austria or Switzerland, that is very helpful to know. All right, but now we need to address some things that you should definitely not focus on when you're choosing ETFs. The first thing, and this is the biggest mistake that beginning investors make all the time, is looking at historical results. People sort ETFs by the highest historical performance and make their investment decisions based on this. This is such a huge mistake because in the financial markets, past results are not indicative of future performance. And this is not just a legal disclaimer, it's actually true. A lot of the time, if a global region or a strategy has been super profitable in the past, that means that now prices are really expensive. There might even be a bubble, and going forward, results are often much, much worse. This is why so many people who jump into sector or theme ETFs end up getting burned. The next thing to mostly ignore is the fund currency. People misunderstand this all the time. So for example, if we look here at this table of ETFs, there's a column called fund currency. And almost all the ETFs have the dollar as a fund currency. And people will tell me, well, I live in the Eurozone. I don't want to invest in dollars. What should I do? Well, here's the thing. The fund currency just describes the accounting currency of the fund. Now, if this is a distributing ETF, it is kind of important because distributions will be paid in the fund currency. But if you're buying an accumulating ETF, the fund currency is basically meaningless. It doesn't affect your life in any way. The truth is, pretty much any of the ETFs on this list can be also purchased in euros. For example, the fund currency here is dollars, but if I open up the ETF and if I go to the section stock exchange, I can look up a listing on a stock exchange like the Stuttgart Stock Exchange or Borsa Italiana or Euronext Amsterdam or Xetra in Germany, where I can buy this ETF in euros. Okay, so the fund currency itself is not that important. Don't obsess over it. And one more factor that I would not prioritize, even though I know that this is going to get me a lot of hate, is dividend yield. There are so many investors out there which think that the best investments are investments that pay a lot of dividends. So they will go on Just ETF and they will sort by dividend yield and look for ETFs which pay more in dividends. But the problem is, with stock investing, your profit comes from two sources: the dividends and the change in the stock price. And a lot of the time, the stocks or industries or types of ETFs that pay the highest dividends don't have the highest total return. In some cases, you can end up buying what are called dividend traps, where you get a dividend yield, but the overall result is quite poor. Basically, financial research suggests that dividends are mostly irrelevant. They should not be a priority in your investment decision making. If you want regular income from your portfolio, you can easily create it for yourself by setting up a regular sale transaction and sell a bit of your ETFs every month, and you will get an income flow without needing to hyper focus on dividends. So here's the thing. A lot of people online will tell you, just buy this one ETF and that's all you need. But as you can probably see by now, there are many small decisions that go into choosing the right investments in each individual situation. And every one of these decisions can make a small improvement, which compounds over the years and makes a big difference for your financial future. If you live in Europe and want to invest your money the smart way, without just blindly following the advice from some online blog, but with full understanding of your choices, you might enjoy the Index Masterclass. It's my step-by-step training program for European investors. To find out more about it, just follow the first link in the description.